There are about 3 of the homework problems that I wanted to go over in a recording. One of them is problem 1. We can see here that there's an amortization schedule showing a 10-year bond and the subsequent payments and charges. The company's year end is December 31st and the financial statements are prepared yearly. This is a really good little problem because it's actually a puzzle and you kind of have to look at this amortization table and figure out what these unknowns are. So ideally, I'd like you to attempt this on your own and then come back and check your answers. Okay, well, getting started. Indicate whether the bonds were issued at a premium or a discount. So we can see that the bonds were issued at $94,349 and then that grew to $100,000. So the $100,000 at the end of the life of the bond, the maturity value is always going to equal its face value. So the maturity value will equal the face amount. And let's talk about that just briefly. So what we're seeing here is that there is a $100,000 face amount. And these bonds were actually issued at a discount down here at $94,349. So they were issued at a discount. And so what we see is that both the financial aspect, the finance piece of bonds, and then the accounting will mimic that as well. The value of the bonds over the life of the bond will grow to equal its face amount or maturity amount, which are the same amount. So the discount, so when the bond is issued at a discount, the value of that, the carrying value of that bond grows and grows and grows until at the end of the life of the bond, the carrying value equals the face amount, which happens to also be the maturity value of the bond. And we can see the same thing, if the bonds had been issued at a premium, let's say $105,000. When the bonds are issued at a premium, likewise, that premium gets discounted, right, gets amortized, not discounted, but amortized back, so that at the end of the life of the bond, its carrying value equals the face amount. So again, we can see that the bonds were issued at a discount here. Is this using the straight line or the effective interest method? So we can kind of go through here and see, and so if it's the effective interest method, they're taking the $94,349 times a certain interest rate. So let's see if we can solve for that interest rate. So interest of $11,322 out of a balance of $94,349 would give us an interest rate of 12%. And likewise, the following year, this $11,361, that was interest based on a carrying value of $94,671. And there again, we'll see 12%. So that's using the effective interest method. And by the way, that's the only method I have gone over in this chapter. I really didn't hit the straight line method because there's really no need, with Excel these days, there's really no need for a company to use the straight line method. It made sense back when these amortization tables were manually prepared, but really it doesn't make sense to use a straight line method because you can so easily plug your formula into Excel and just copy it down and you're done. So, given that we can copy all of this down, the effective interest method just, it's theoretically the correct method to use. And really the straight line method no longer saves time like it used to when everything was done manually. Okay, we just solved for the effective interest method because I took interest expense, and again this column, because it's changing, that's the interest expense amount, isn't it? And this cash would be the cash interest payment. So the cash interest payment would be $11,000. That would have been based on the face amount of $100,000, so 11%. So again, here's the cash payment. That's, so again, this is based on the contract. If the contract rate is 11%, the contract face amount is $100,000. Multiply those two together and you'll get an annual payment of $11,000. Okay, then they want us to prepare journal entries at the beginning of the bond. So, on January 1, they want us to make the journal entry for this. So the carrying value, so cash would have come in of $94,349. We would put $100,000 in the bond itself. So let's look at that entry. So cash comes in of $94,349. Bonds payable is credited to increase at $100,000. And then we would plug the difference. We need a debit to balance of $5,651. That will go to the discount because the bond sold at a discount. Okay, and then at December 31st, what would be the journal entry? So let's go to year end. Here's our interest payment and our interest expense. So we're going to debit interest expense, credit cash, or interest payable. So we can see here's our interest expense, $1132. Here's our credit to cash, or they're using interest payable. Those don't balance. We need a credit to balance, $322, and that's going to be used to reduce the discount. So the discount goes up with debits and down with credits. And then we jump to 2015. So prepare the journal entries to reflect the bond transactions for 2015. So first off, let's look at the end of 2014, we would have had an interest payable of $11,000, right? Just like we have here at the end of 2008, there is this interest payable of $11,000. That's going to be the same amount year after year after year. Let's take a peek at that. Again, we will have a credit to interest payable every year in because the payment doesn't actually take place until January 1. So on January 1, we're going to reduce our interest payable and record the cash payment. So again, this accrual of the payable, and then it gets paid on January 1. Now let's take a peek at December 31st. Then at December 31st, we're going to have entries for these amounts for interest. So again, we would debit the interest expense, credit the interest payable. We need another credit to balance. That's going to be applied to the discount. So this is a really good little problem of just making you solve for particular unknowns with the bonds. So you really have to understand bonds in order to work through this. And if you are able to work through this, that's a really good sign that you understand the concepts. Another one of the Wiley Plus assignments that I wanted to go over is this brief exercise 13. So we can see that they're issuing a 4-year note, $75,000, and it says it's zero interest-bearing note. And then it gives us the cash, so we don't have to solve for the present value. It gives us the cash receipt. And then it says the implicit interest rate is 12%. So again, we know in substance there's no such thing as a zero interest-bearing note because time is money. And so we're going to count for the note not at $75,000, but at this $47,664. So we debit cash for the amount received, and then we'll put the face amount in the note, and the difference is the discount. So when we go to the balance sheet, we're going to see a note payable for $75,000, and then we'll reduce that by the discount on notes payable for that $27,336, and so the net value, the net amount is $47,664, and all of that would get reported on the balance sheet. Okay, then that's on January 1, and then December 31st rolls around. So we will take the carrying value of that note, $47,664, and the implicit rate is 12%. And that will give us interest expense of $5,720. And so we record interest expense and reduce the discount. So after this is finished, we would have notes payable again, $75,000 on the balance sheet, but the discount would have gone from $27,336, and we would have reduced it by the $5,720 for a new balance of $69,280. So now the carrying value of the note is, oops, I said that all wrong. So I've come in and corrected that. So again, the note payable will stay at $75,000. The discount started at $27,336. We'll reduce it $57,20. So its new balance is $21,616. Then the carrying value, $75,000 minus the $21,616, gives us a carrying value of $53,384. So the carrying value is growing, isn't it? And eventually, by the end of the 4 years, the carrying value will be how much? $75,000. So at the end of the life of the note, the discount will zero out, and we will only have a balance in the notes payable. Okay, let's also look at brief exercise 14. So I'll let you read through that, and then I'm going to come back and we'll look at these entries. Okay, so they have exchanged a note for equipment, and if they had bought that computer, actually the computer elsewhere, they would have paid $31,495. So that is its fair value, if you will. So we're recording this asset received at the fair value, at its fair value. So remember back in chapter 12, actually I guess chapter 10, 11 and 12, we record long-term assets in an exchange at the fair value of whatever is received or given up, whichever is more reliable. So we know the fair value of the computer, and then the note, we put the face amount in that, and then we're plugging this difference to the discount. And so that note would have a carrying value of this $31,495. And so at the end of the first year, again, we have an applied rate of 12%. So we can calculate our interest expense. So we net these two together. These two accounts get netted together for a carrying value of this times 12%. That will give us interest expense of $3,779. So we record that as interest expense. In this particular problem, there actually is a cash payment of 5%. So $40,000 at 5% is a $2,000 cash payment each year. So this was a little unusual with that. So we have our expense, we have the cash payment, and the difference gets plugged to the discount to reduce it. The other thing I want to add on here is that given we bought a computer, they're also at December 31st, we would need to make a journal entry for depreciation expense and also credit accumulated depreciation. So let's just assume that this equipment with a value of $31,495, so with a cost of that, let's say that it has a 5-year life. So let's just say it's 5-year life with no salvage value. So that's going to give annual depreciation expense of $62.99. And so I just want to add that in because really we bought a computer with debt. So we made the adjusting entry relative to the debt, but there also would have been an adjusting entry for the computer itself and its depreciation.